Welcome back to our Ask the Advisors series. Along with tax season, we thought appropriate to hit on several tax topics that we see a lot around this. So today's question is basically, what are the differences, or maybe what even is or are tax credits versus tax deductions? So obviously with taxes coming up, a lot of us start to focus on ways to reduce our taxes, whether it was for last year, this year, or in the future. And credits as well as deductions are good tools that you should definitely be looking at to help limit your tax bill, but they're not the same thing. So a tax credit is traditionally the best benefit of them all. This is actually funds that will pay or reduce the actual amount of taxes that you owe dollar for dollar. These can be education credits, parental credits, so if you have kids or supporting kids, also around retirement, so contributions or earned tax credits around contributing to a retirement plan can be a tax credit. This also could be some of the energy efficient tax credits. So if you earn a $1,000 tax credit through one of these things, it will actually reduce your tax bill by $1,000 as long as you qualify. So that once again reduces your tax bill dollar for dollar. If traditionally you didn't even owe taxes, it would increase your tax refund dollar for dollar. So when focusing on tax credits or tax deductions, credits are definitely the most lucrative one, and that's where we should probably start. However, they're not as available or not as many as maybe deductions are. So deductions are things that simply reduce or can reduce our taxable income. So think of mortgage interest deductions, charitable donations, depreciation. We hear a lot on real estate investments about depreciating assets is a great deduction. Also certain travel could be, or educator expenses. So there's a lot of deductions out there, numerous, but traditionally deductions will only reduce the amount of income that is reported on taxation. So let's say I have $100,000 of taxable income this year, but I can come up with $20,000 worth of deductions. So whether it's charitable, mortgage, let's say a depreciation, it's going to reduce my taxable income from $100,000 to $80,000, which will reduce my tax benefit, but a $20,000 deduction does not equal $20,000 less in taxes. Okay, so it's going to be a portion of that. The other thing to consider is these deductions may not even be worthwhile. So let's say I add up all my deductions this year and I put some money in charity, I have my mortgage interest. However, if typically your standard deduction exceeds the itemized deductions that you have, you're not going to get any necessary benefit directly for these so-called deductions because you would take the standard deduction. So many things out there. I see a lot of videos, especially how certain things are really good because you get a deduction. They can be really good, and getting deductions can be a great tax benefit, but you've got to make sure that the deduction is worth the expense of buying it. So just because you can buy a car this year for the business and get a deduction, it's only going to save you a small portion of that, or maybe you don't even qualify for the deduction. So be very careful with deductions. You definitely want to keep track of all your deductions. Do research, Google all the types of deductions you can, and be very mindful of it. But like I said, there's a big difference between the credits and the deductions, which is why I usually start with the credits. Thank you for listening in again. As always, we'd love your help with future questions that we can answer. So if you have a specific question that you'd like for us to address, either enter it in the comments section below or reach out to us by email in our contacts page. Thank you again.